In the summer of 1929, just weeks before the most famous financial collapse in modern history, the majority of Americans believed they were living in the safest and most prosperous era humanity had ever created. Corporate profits were strong, new technologies were transforming daily life, unemployment was low, and newspapers spoke openly about a future where economic downturns had been permanently defeated. Yet, buried beneath this confidence was a quiet, deeply uncomfortable reality that almost no one wanted to confront. The economy was no longer being driven by productivity or real wealth creation, but by belief itself, by the assumption that prices would always rise, that credit would always be available, and that risk had somehow been tamed by progress. And this invisible shift, more than any single stock market crash or policy mistake, was the true fault line that broke the system. Because when an economy begins to depend on shared faith rather than tangible foundations, it becomes fragile in ways that are not immediately visible. And this is where the real warning begins, not with falling prices, but with a society that no longer understands what its prosperity is built on. To understand why this matters now, it is necessary to step back into the psychological atmosphere of the late 1920s, an era often simplified into cliches about reckless speculation and stock tips, but in reality far more subtle and unsettling, because the people who fueled the boom were not foolish gamblers detached from reality. They were ordinary citizens responding rationally to the incentives placed in front of them. As the United States emerged from World War I as a global industrial powerhouse, productivity surged, electricity spread across cities, automobiles reshaped transportation, radios connected households, and mass production lowered the cost of consumer goods, all of which created genuine economic growth. But layered on top of this growth was a financial system that increasingly rewarded leverage over patience, speed over sustainability, and optimism over caution. Banks expanded credit aggressively. Brokers allowed investors to buy stocks on margin with as little as 10% down. Corporations borrowed heavily to expand capacity, and households, for the first time on a large scale, learned to live comfortably with debt. Not because they were irresponsible, but because debt appeared safe in a world where incomes and asset values seemed to rise together. The crucial shift occurred when rising prices stopped being the result of underlying productivity and instead became the justification for further borrowing, a circular logic that fed on itself, as higher stock prices encouraged more margin loans, which pushed prices higher still. And this feedback loop was not hidden. It was openly discussed and celebrated, with respected economists and policymakers arguing that financial innovation had reduced risk, diversified exposure, and smoothed the business cycle, creating what they believed was a permanently high plateau of prosperity. Yet this belief carried a hidden cost, because when confidence becomes the foundation of an economic system, it transforms risk from something that is managed into something that is denied. What few people fully appreciated in 1929 was that the system had become extraordinarily sensitive to small disruptions, not because participants were ignorant, but because incentives rewarded short-term gains while quietly transferring long-term risk into places no one was watching. Banks bundled loans, brokers extended credit, corporations relied on continuous refinancing, and households, for the first time on a large scale, learned to live comfortably with debt. Not because they were irresponsible, but because debt appeared safe in a world where incomes and asset values seemed to rise together. When the stock market finally cracked in October 1929, the initial decline was not catastrophic. Prices fell sharply but not unpredictably by historical standards, and many investors initially viewed the drop as a healthy correction, an opportunity rather than a threat. Yet the deeper danger was not the fall in stock prices themselves, but the sudden reversal of confidence that followed. Because once prices began to fall, the logic of leverage reversed. Margin calls forced investors to sell, selling pushed prices lower, lower prices triggered more margin calls, and the same feedback loop that had driven the boom now accelerated the collapse. But the most devastating consequences occurred outside the stock market, in the credit system, where banks that had extended loans against inflated assets suddenly faced losses they could not absorb. Depositors, sensing danger, began withdrawing funds, and without modern deposit insurance or central bank backstops, these withdrawals quickly became bank runs. The collapse of credit transformed what might have been a severe recession into a systemic depression. Businesses lost access to financing, factories shut down, workers were laid off, and as incomes fell, households defaulted on debts, further weakening banks, creating a downward spiral that fed on itself. And the tragedy was not simply economic, but psychological, because the same optimism that had fueled the boom now turned into paralysis, fear, and mistrust as people stopped spending, stopped investing, and stopped believing that recovery was possible. Yet the most important lesson of 1929 is not that speculation is dangerous or that markets can crash. These truths were known long before. The deeper warning lies in how societies misinterpret stability, because in the years leading up to the crash, the system appeared robust precisely because stress was being deferred rather than resolved. Small failures were absorbed by expanding credit, rising asset values masked structural weaknesses, and policymakers interpreted calm markets as evidence of sound fundamentals, when in reality, calm was the result of suppressed volatility. And this pattern, the conversion of fragility into apparent stability, is the recurring theme that reappears throughout financial history. In the decades after the Great Depression, reforms were introduced to prevent a repeat. Banking regulations were strengthened, leverage was limited, deposit insurance restored trust, and central banks assumed a more active role in stabilizing the economy. And for a time, these measures worked. But over generations, memory faded, incentives shifted, and new forms of leverage emerged, not always in the same visible ways, but embedded in more complex financial instruments, global capital flows, and institutional structures that promised efficiency while quietly reintroducing fragility. What makes the warning from 1929 particularly relevant is not that history repeats exactly, but that human psychology does, especially under conditions of prolonged stability, because long periods without crisis tend to produce the belief that crisis is no longer possible. And this belief subtly reshapes behavior, encouraging risk-taking, discouraging skepticism, and rewarding those who push boundaries while marginalizing those who urge caution. By the mid-1920s, voices warning of excessive speculation existed, but they were dismissed as pessimists who did not understand the modern economy. And something similar happens in every era of sustained growth, as systems adapt to reward conformity with prevailing narratives rather than independent judgment. Another often overlooked aspect of the 1929 collapse is that it was not caused by a single villain or decision, but by a collective shift in incentives, where individuals acting rationally within the system collectively produced an irrational outcome, a phenomenon economists later described as a coordination failure, but which is better understood as a misalignment between private incentives and public stability. Because no individual investor or banker intended to cause a depression, yet the system as a whole moved toward one, because the structure rewarded behaviors that increased systemic risk while disguising it as progress. This is why the warning is so uncomfortable, because it suggests that danger does not come from obvious excess or visible corruption, but from normal, even respectable behavior amplified by scale and repetition. As the 1920s progressed, wealth inequality also widened, not as a deliberate policy outcome, but as a natural consequence of asset-driven growth. Those who owned stocks, businesses, and real estate benefited disproportionately, while wages lagged behind productivity gains, creating an economy increasingly dependent on credit to sustain consumption. And this imbalance mattered because it made the system more sensitive to shocks. When asset prices fell, the wealth losses were concentrated, but the economic consequences spread broadly, reducing spending, employment, and confidence across society. When the crash finally arrived, policymakers initially misunderstood its nature, viewing it as a market correction rather than a systemic failure, and this misdiagnosis delayed effective responses, allowing the downturn to deepen. And this, too, is part of the warning, because systems that appear strong often blind their caretakers to underlying weaknesses, making early intervention politically and intellectually difficult. It is tempting to view the Great Depression as a distant anomaly, a product of a less sophisticated era, but the structural dynamics that led to it have never disappeared, they merely change form. Leverage migrates, risk is repackaged, and narratives evolve, but the core tension between growth driven by fundamentals and growth driven by belief remains unresolved, and when belief overtakes reality, the system becomes vulnerable to abrupt reversals. The truly unsettling lesson of 1929 is that the collapse was not unpredictable. Many indicators pointed to excess leverage, fragile credit structures, and speculative fervor, but these signals were overshadowed by the dominant story of progress and permanence, and people tend to trust stories that validate their recent experiences, especially when those stories are reinforced by authority, expertise, and success. As the economy recovered in the years following the Depression, new safeguards were put in place, but they were responses to the last crisis, not guarantees against the next. And over time, financial innovation and globalization introduced new complexities that made risk harder to see and easier to ignore. While central banks, tasked with smoothing cycles and preventing panic, became increasingly relied upon to absorb shocks, creating an implicit expectation that severe downturns would always be managed or prevented, an expectation that itself altered behavior by encouraging greater risk-taking under the assumption of rescue. This dynamic, sometimes described as moral hazard, is not a moral failing, but a psychological one, because when protection exists, people naturally use it. And when safety nets are perceived as infinite, risk expands to fill the space available. The warning embedded in 1929 is not a prediction of inevitable collapse at any specific moment, but a caution about the conditions under which systems fail, namely when leverage accumulates faster than resilience, when confidence substitutes for understanding, and when short-term incentives overwhelm long-term stability. As economic systems grow larger and more interconnected, their tolerance for error can paradoxically decrease because small disruptions propagate through networks of obligation and expectation. And the more complex the system, the harder it becomes to identify where risk truly resides, which increases reliance on simplified indicators like market prices and growth rates, even though these indicators often lag behind underlying conditions. The late 1920s were marked by impressive surface-level metrics, rising GDP, expanding markets, technological innovation, but beneath these metrics lay an economy increasingly dependent on continuous expansion to service accumulated debt. And this dependence meant that any interruption, no matter how modest, could trigger cascading failures. One of the most haunting aspects of the Great Depression is how quickly the social contract unraveled once economic trust collapsed. Because money is not merely a medium of exchange, it is a shared belief system. And when that belief is shaken, the effects extend far beyond balance sheets, influencing social cohesion, political stability, and individual identity, as people measure their worth and security through economic participation. The warning that emerges from this history is not that growth is dangerous, but that growth without resilience is brittle, and resilience requires slack, redundancy, and a tolerance for short-term discomfort, qualities that are often sacrificed during long expansions because they appear inefficient or unnecessary. In 1929, efficiency had become a virtue. Inventories were optimized, credit was streamlined, capital was allocated aggressively, and these efficiencies magnified returns during the boom, but accelerated collapse during the bust, illustrating the trade-off between efficiency and robustness that continues to challenge modern systems. The most unsettling realization is that the people living through the late 1920s did not feel reckless. They felt prudent, forward-thinking, and aligned with the future. And this self-perception is what made the warning signs so easy to dismiss, because acknowledging systemic risk would have required questioning not just financial practices, but the broader narrative of progress that defined the era. History does not offer simple lessons or guarantees, but it does reveal patterns of behavior that recur when human psychology interacts with complex systems. And the warning from 1929 is that danger often arises not from ignorance, but from overconfidence, not from chaos, but from apparent order, and not from sudden shocks, but from slow accumulations that feel benign until they're not. When an economy becomes structured around the assumption that tomorrow will always resemble yesterday, flexibility diminishes, and the capacity to absorb surprise weakens, leaving the system exposed to events that would otherwise be manageable. The final and perhaps most disturbing aspect of this warning is that it operates quietly, without dramatic signals, because the transition from stability to fragility is gradual and largely invisible until a tipping point is reached, at which moment the narrative shifts abruptly, and what once seemed unbreakable is revealed to have been precarious all along. And the people caught within it are left wondering how something that felt so secure could unravel so completely. A question that echoes through history, not as a call to fear the future, but as a reminder that the greatest risks are often the ones that feel most familiar.